Cody, Jacob here. Today we're looking at company 21, our generic stock screener, ticker symbol AKAM in the IT services industry. You're looking at 15.5 billion market cap, over 18 billion enterprise value, incorporated in 1998 in Massachusetts. They provide cloud computing, security, and content delivery services. Their growth has been very consistent. The lowest, let's look at the last 9 years. Highest growth year over year of 11.9%, lowest of 4.5%. So they've definitely been very consistent with their growth. We are seeing, however, declining gross and operating margins. That's not a positive to me. Their return on invested capital has also been going down. We're looking at it was as high as 11%, 9%, and it's averaging more along the lines of that 8.5% now. So possibly greater than weighted average cost of capital, but really not a fantastic return on the money reinvested back in business. Your balance sheet shows 400, well, with short-term investments, so cash-like products, you're looking at about $870 million with zero short-term debt and 3.5 billion long-term debt. So they've really been leveraging themselves, which you can see from their what was this, 2018 to 2019, went from 874 million in debt to 1.8, to 1.9, to 2, to 2.3, to 3.5. So they're really trying to push some growth here. And I mean, there's not, as long as it relates to cash flow, it's not terrible. And we're here and we see maybe 800 million, which is still less than 5 years. Their 5-year average free cash flow to pay down that debt. It's not a huge concern, but I am concerned that it's gone up so fast so recently. So really, what that's telling me is this growth, fantastic. I love to see it, but if you have to go into debt to leverage yourself to get that growth, it's a little bit more scary. I mean, think about owning a home. If you own a home outright, historically you've made, let's say, 5% on your house. Not a big deal. That's pretty solid. Like whatever, it's not a solid investment, but for it being a home buying experience and thinking about it less as an investment, not bad. But if you leverage it, if you put 20% down, and you offset that by thinking the rest, you get 10%. Plus, your house is going to be the same price as it would be in 30 years. You just paid a little bit more. I mean, you're probably looking more along, a much greater return. And when you leverage your return, it's easy to make it look artificially good, but in the background of the business, things can get a little scary a little quick. So just keep that in mind. We are seeing both cash from operations and capital expenditures roughly double from 10 years ago, but you're still looking at, what that means, double free cash flow. Their use of cash, they do a lot of things. So a little bit of reinvestment, a little bit on the acquisition side, share repurchases quite a bit, and issuing a bit of debt. So no dividend. They really focus on increasing the value of the business and then repurchasing shares, which, again, you as the shareholder are not going to physically get any of these dollars, but these should be bumping up the share price. All else equal. Obviously, if you have a 100p company and they're buying back shares, reinvesting back in themselves, and it dampens down to 20, you'd have to almost 5 times your business and you haven't gone anywhere from a stock price perspective. But here we see that they are trying to reinvest through acquisitions and organically, and then quite a bit of money for share repurchases. So if we go to assumption setting, I think that to me, I'm going to dampen the revenue growth because again, you got to balance out with what you want the company to do with what they've done historically. And they've grown extraordinarily consistently, but recently they've been leveraging to get that type of growth. And so I'm going to say, let's say 5% revenue growth. And then for P price free cash flow, I feel pretty good with a 16 there. 15 on the discount rate. Margins, we're looking at free cash flow is so much greater. That is just incredible. How is it so much greater? Do they have crazy depreciation? Okay. Yeah, their depreciation more than and amortization more than offsets their capital expenditures. So you're seeing a heavy inflow of cash from operation, free cash flow. So maybe let's do 1822 share repurchases. So initially you just think, 150 million would be 1%, but you also have to offset stock-based compensation. So 1% reduction of shares is actually more like 450 to $500 million, and 450 $500 million plus another 150, you're looking at about 600, 650. So let's say they do that, 2% of free cash flow, but you're also looking at 60 to 70% use of your free cash flow. So you're leaving about 40% to get this type of growth through both acquisition and reinvestment, get these type of margins. And we're saying the price needs to fall essentially in half um, before you get to the investment that I'm looking for with a 15% discount rate. I feel pretty good about these assumptions. I mean, they've been growing very consistently on the revenue growth side. The margins I feel pretty good about. 2% share change might be slightly higher, maybe 1.5 seems a bit appropriate because, again, you got to balance out what the company's doing with, um, what they've done in the past, what you want them to do. And I think 2% is pretty close to in line of 60% payout, which is what they've done historically, leaving about 40% to reinvestment and acquisition. So I feel pretty good about this, and we're just saying feel pretty good about the company, good company, just not at the price point that looks extremely attractive to me, but definitely one I would add to a list to possibly get if it did fall to a price that looked attractive. I do hope you enjoy the video and grow your day. Thank you.